Hello, I'm Travis, and today we're going to break down one of the biggest macro developments in markets right now, and that's the temporary ceasefire we're seeing between the U.S. and Iran. That's all over the news, and what it actually means for investors. So, because the markets rallied pretty hard on the headline of the ceasefire, but the real story is obviously a lot more nuanced here, right? So here's the setup. After weeks of escalating conflict that disrupted the global energy supply, especially through the Strait of Hormuz, which carries about 20% of the world's oil, the U.S. and Iran agreed to a 2-week ceasefire. So 2 weeks. That single headline immediately removed what markets fear most, uncertainty. And the reaction was fast and aggressive. I mean, oil prices collapsed double digits, the Dow surged over 1,300 points, and the NASDAQ jumped more than 3%. Bond yields fell, and rate cut expectations all of a sudden increased again. In short, markets priced out worst case scenarios almost instantly, right? They have a good habit of pricing them in. In this case, they price them out almost instantly. So to understand this move, I mean, you have to understand what was priced in actually before the ceasefire. Markets weren't just reacting to a war, they were reacting to a brutal energy shock. When Iran restricted access to the Strait of Hormuz, oil spiked to over $100 a barrel, and that triggered fears of higher inflation, delayed Fed rate cuts, and even a global recession as a result. And that's why the ceasefire mattered so much. It didn't just reduce the geopolitical risk involved here, it directly impacted inflation expectations that everyone's watching. Because lower oil equals lower inflation pressure, which equals more flexibility for central banks. That's the chain reaction markets are trading right now, how that all unfolds. Now, here's the part where investors need to be the most careful about. This is not a peace deal. This is a temporary ceasefire. We're talking only 2 weeks right now. And markets seem to know that. I mean, even after the initial drop, oil is still hovering in that $90 to $100 range, well above pre-war levels here. So they're not 100% certain this is done. And that's because the underlying issues really haven't been resolved. I mean, the Strait of Hormuz isn't fully open. It's only partially open right now. The infrastructure damage that we've seen over there could take months to fix to get things moving again. And tensions in the region are still high. They're still very active. Some analysts are even already warning that if the ceasefire fails, what could happen to oil? It could spike again very dramatically, or potentially very dramatically. So what you're seeing here is risk being repriced, not eliminated. There are really 3 key takeaways that you need to consider when we're thinking about this conflict. So energy is still very much a driver in markets, right? Oil remains the most important variable. If it stabilizes, markets can rally. If it spikes again, everything reverses. We could see a negative reaction just like we saw the positive reaction here. Volatility is very much back into the market, right? This is not a set it and forget it environment. Markets are going to react quickly to headlines, both positive and negative. And the Fed just potentially got optionality back if this holds, right? The ceasefire slightly increases odds of a rate cut, although it's unlikely, but that depends entirely on if inflation actually will cool from here. So, bottom line, the ceasefire is a short-term bullish catalyst, but not a long-term solution. Markets are celebrating this relief. It's not a resolution, and until there's a durable agreement in place, geopolitics will continue to be one of the biggest macro themes driving markets in 2026.